We shall commence this module by discussing about the importance of finance. Finance is the essence of modern day business and economy. It is essential in business for meeting the working capital needs, for purchasing the assets required to run the business, and for other essential purposes. All these requirements are not self-financed, but these are satisfied through the network of financial intermediaries. Financial intermediaries borrow money from the savers and make it available for those who are requesting the money. In this way, they serve as a link between borrowers and lenders. Nowadays, financial intermediaries play the important role in the economy in keeping the financial transactions moving. In normal times, these intermediaries are quite liberal in their operations, while during recession they tighten their requirements so that providing money would not be really easy. Depositors provide funds to financial intermediaries for short term and later lend funds to the borrowers for long term. The prior role of these institutions is provision of finance while taking additional risk. Financial intermediaries exist because they cater to different requirements of depositors and lenders at low transaction cost and reduce the adversity of asymmetric information. There is a link between the monetary policy and the financial intermediaries. Let us explore the important functions and role of financial intermediaries in detail. After studying this module, you shall be able to know the meaning of financial intermediation and financial intermediary, learn about different types of financial intermediaries, identify the functions of financial intermediaries, evaluate the role of financial intermediaries in the expansion of economy, and analyze the link between financial intermediation and monetary policy. Let us now understand the meaning of financial intermediaries. An economy is said to be in equilibrium when savings are equal to investment. There exist savers as well as investors in an economy. Investors are called as deficit spending units or DSUs since they are spending more than their income. Investment is also one of the component of expenditure. On the other hand, savers are called as surplus spending units SSU since they spend less than their income. Savers therefore fulfill the needs of investors. For channelizing these savings into investment, there arises a need of some means. There can be direct channelization under which savers directly transfer their savings to investors for investment purpose. This is called direct finance, and the example of direct finance include initial public offering, that is IPO, where company directly procure funds from public. However, direct finance is a risky venture since savers are not so expert in analyzing the financial credibility of investors. As direct finance is risky and somewhat expensive scheme, so majority of savers prefer to hire the services of intermediary for converting their savings into investment. These intermediaries accept deposits from the savers and distribute these funds to investors. The concept of intermediary between savers and investors is known as financial intermediation and is a form of indirect finance as against direct finance, since in this form savers channelize their savings to investors not directly but in an indirect way through financial intermediaries. An entity that acts as middlemen between two parties in a financial transaction is known as a financial intermediary. Financial intermediaries thus serve as a link between savers and investors. The theory of financial intermediation is based on commission. The financial intermediaries work with two types of interest rates. These interest rates are deposit rate and lending rate. Deposit rate is the rate of interest which is paid by financial intermediaries to savers on their deposits made with these financial intermediaries. In contrast, lending rate is the rate of interest which is charged by financial intermediaries from the investors whom have taken funds for investment purpose from the financial intermediaries. Lending rate is higher than deposit rate and commission earned by financial intermediary is calculated as the difference between lending rate and deposit rate. Commercial banks are the best known banking financial intermediaries. Apart from commercial banks, there exist other financial institutions such as investment banks, insurance companies, broker dealers, mutual funds and pension funds. Multiple benefits are offered by financial intermediaries to the customers, including safety, liquidity and economies of scale. They channel funds between borrowers and lenders, thereby improving social welfare by channeling resources to their most effective use. Financial intermediaries get profit in the form of the difference between the interest charged to the borrower and the interest earned by the lenders. In recent years, the financial system all over the world has undergone dramatic transformation. Financial markets such as stock and bond markets have grown in size and volumes traded. Besides, there has been financial innovation to a great extent, which includes introduction of new financial products such as securitized assets as well as derivative instruments like swaps and complex options. New exchange for financial features, options and other derivative securities have arose and become dominant markets at the same time. Due to this, the importance of different types of intermediaries has undergone significant change. Mutual funds and pension funds have grown tremendously in scope, while the growth of insurance companies has not been up to the mark. Recent intermediaries like GE Capital have come up which raise money completely by issuing securities and not at all by deposits. In essence, it can be said that traditional intermediaries have declined in importance even as the sector itself has been expanding. And significant change in the activities of the intermediaries is the growth in the prominence of risk management activities undertaken by financial intermediaries. The alteration in the market breadth available for hedging risk has not led many individuals to manage financial risks at their own. In fact, risk management has become a fundamental activity of many intermediaries. Examples of financial intermediaries include: number 1, commercial banks. Commercial banks are the primary bank financial intermediaries. People deposit their savings with commercial banks, which these banks in turn lend as loans to those who need credit. They are itself a financial intermediary, and sometimes they invest deposits in various NBFIs to earn higher returns. Second is insurance companies. In case of a risky investment, insurance guards against the risk of default. In such a scenario, it is easier to get insured by an insurance company rather than an individual to help spread the risk of default. Third is financial advisors. A financial advisor doesn't directly lend or borrow but offers specialist advice which saves time spent on looking for best investment. Fourth is credit unions. Credit unions are banks of informal types that furnish facilities for lending and depositing within a particular community. Fifth is mutual funds or investment trusts. Mutual fund investment schemes pool the small savings of individual investors and facilitate a bigger investment fund. It enables small investors to gain from being member of a larger investment trust. Sixth is development banks. These banks offer credit to serve the needs of a particular industry or sector in the economy for its development. Now, moving on to discuss the types of financial intermediaries. Financial intermediaries are basically of two types. First is bank financial intermediaries or BFIs, which include central bank and commercial banks. And the second is non-bank financial intermediaries or NBFIs, which include insurance companies, mutual funds, investment companies, pension funds, discount houses, building societies, etc. A major difference between the two is that while banks' liabilities, that is demand deposits, are widely accepted as a means of payment in settling debts, this is generally not the case with NBFIs. Sometimes banks invest their deposits with NBFIs to earn return on investment. NBFCs are commonly known as finance companies and are corporate bodies which concentrate mainly on lending activities in a well-defined area. The Reserve Bank of India Amendment Act 1997 defines an NBFC as a financial institution or non-banking institution which has its principal business of receiving deposits under any scheme or arranging and lending in any manner. In India, there is a wide unorganized sector catering to the financial needs of the country. This unorganized sector affects the working of the monetary policy in our economy. In India, the major players in the unorganized sector include moneylenders, indigenous bankers, chit funds, nidhis or mutual benefit funds, self-help groups, cooperative societies, etc. Financial intermediaries have a lot of variety across different countries. The typical financial intermediaries are, in Indian context, commercial banks, for example, State Bank of India, Citibank, ABN AMRO, HSBC, etc. Building society, for example, HDFC, HUDCO, etc. Development banks, for example, NABARD, SIDBI, IFCI, IDBI, etc. Credit unions, financial advisor or broker, insurance company like GIC, Lloyds, IFCO Tokyo, life insurance companies like LIC, mutual funds, for example, UTI, Morgan Stanley, Reliance Mutual Funds, etc. and pension funds like PPF, EPF, etc. Next, moving on to discuss the important functions of financial intermediaries. Financial intermediaries play an important economic function by facilitating a productive use of the community's surplus money. Financial intermediaries perform the basic function of transforming financial assets acquired through the market and constituting them into a different, more preferable type of asset which becomes their liabilities. The important functions of financial institutions are: number 1, pooling of resources from small savers. It is difficult to assume that borrowers and lenders with similar financial needs will coincide automatically. The different needs of buyers and sellers are matched effectively by the financial intermediaries. Financial intermediaries accept deposits in denominations that differ from those of loans they make. Through this, they remove the need for a coincidence of wants on the basis of size. Banks, for example, pool many small deposits and use this to make large loans. Insurance companies collect and invest many small premiums in order to pay fewer large claims. Mutual funds accept small investment amounts and pool them to buy large stock and bond portfolios. Every financial intermediary must attract many savers in order to have a larger pool of resources. Second main function is providing liquidity. Liquidity is a desirable property which refers to the ease and convenience with which an asset can be converted to a means of payment. Financial intermediaries facilitate transformation of various assets into means of payment through ATMs, checking accounts, debit cards, etc. For maintaining this, financial intermediaries must have smooth flow of funds so as to meet their obligations while profiting from the spread between long and short-term interest rates. Economies of scale allows intermediaries to do this at minimum cost. Third main function is diversification of risk. Diversification is a powerful tool in minimizing risk for a given level of return. Financial intermediaries help investors diversify their investment in such a way that they will not be able to at their own. Mutual funds pool the funds of many investors to purchase and manage a stock portfolio so that investors achieve stock market diversification for small sums also. Banks spread depositor funds over many types of loans, so the default of any one loan does not put depositor funds in trouble. Fourth is to facilitate portfolio creation. Portfolio is a collection of financial assets. This results in economies of scale and scope. Economies of scope arises because intermediaries are engaged in complementary activities, while economies of scale is the result of lower unit cost due to large scale operations. Fifth is reducing asymmetric information problem. Moral hazard and adverse selection are the problems associated with financial services. Moral hazard is the lack of incentive to guard against a risk for which a person does not have to bear the adverse consequences. This generally happens in case a person takes insurance and behaves irresponsibly. Adverse selection happens when all the parties involved in the exchange are not having same and equal information. Financial intermediaries, on account of their comparative advantage in the provision of specialized services, are better placed to fight with asymmetric information problem. By reducing this problem, they can make profits. Sixth is providing safekeeping, accounting and payments mechanism for resources. Banks are the safest place to keep money. Apart from this, banks keep the records of payments, deposits and withdrawals and the use of debit or credit cards and checks as payment mechanisms. Financial intermediaries can do all of this and much more cheaply on account of economies of scale in its operation. All of these services are standardized and automated on a larger scale, so per unit transaction costs are minimized. Next, we shall discuss about the role of financial intermediaries. The main role of financial intermediaries is in reducing transactions cost and the problem of asymmetric information in financial markets. Apart from these, financial intermediaries facilitate the transfer of risk and help in providing advisory services, thereby making the participation in capital markets easy by simplifying the dealings with the complex maze of assets and instruments. The role of financial intermediaries can be explained. First is, financial intermediaries help reduce poverty levels. Over time, the role of financial intermediaries has undergone a dramatic transformation. FIs keep themselves involved in finding innovative ways to provide financial services to the poor so that they can improve their productive capacity and quality of life. Most of the poor live in the rural areas and are engaged in agricultural activities with limited access to conventional credit and insurance markets. Most formal financial institutions do not serve the poor because of perceived high risks, high costs involved in small transactions, perceived low profitability, and probable inability to provide the physical collateral required by such institutions. FIs, by providing efficient microfinance to the poor, can help in enabling the poor to smoothen their consumption, manage risks better, gradually build assets, develop micro enterprises, enhance income earning capacity, and generally enjoy an improved quality of life. They also help in improved resource allocation, development of financial markets and system, and ultimately economic growth and development. Apart from this, they help in active participation of vulnerable sections in benefiting from development opportunities. Next, we will talk about pension funds as financial intermediaries bring about financial smoothing to people. Pension fund is a form of institutional investor which collects, pools and invests fund constituted by sponsors and beneficiaries to provide for future pension entitlements of beneficiaries. It provides a means for individuals to accumulate savings over their working life so as to finance their consumption needs in retirement. Pension funds boost the efficiency of the financial system by influencing the structure of securities markets. It helps to generate liquidity. It offers a mechanism for pooling of funds and subdivision of shares as they offer much lower costs of diversification by proportional ownership. Pension funds can also offer the possibility of investing in large denomination and indivisible assets such as property, which are unavailable to small investors. Pension funds also provide risk control directly to households via the form of retirement income insurance they provide. To assist in undertaking this risk control function, they diversify assets and also act in securities and derivatives market to hedge and control risk. Third main function of financial intermediaries is to act as resource providers. Financial intermediaries have an important role of a temporary resource provider when there is a time lag between the firm's factor payments and receipts from sale proceeds. This role becomes all the more important when the firms do not have enough resources of its own to cover its factor payments. In such a scenario, financial intermediaries come in and provide working capital finance. Fourth main function is to provide inducement to save. Bank and non-bank financial intermediaries play an important role in promoting savings in the country. Savers need stores of value to safekeep their savings in. These institutions provide a wide range of financial assets as store of value and make available export financial services to the savers. As store of value, the financial assets have certain special advantages over the tangible assets such as physical capital, inventories of goods, etc. Financial assets are easily storable, more liquid, more easily divisible and less risky. In fact, saving income ratio is positively related to both financial institutions and financial assets. Financial growth induces larger savings out of same level of real income. Next, we will talk about insurance markets as financial intermediaries in promoting economic growth. Insurance market activity, both as financial intermediary and as provider of risk transfer and intermediation, promote economic growth by allowing different risks to be managed more efficiently by encouraging the accumulation of new capital and by mobilizing domestic savings into productive investments. The insurance activity contribute to economic growth in the following way. Number one, promoting fiscal stability. Secondly, facilitating trade and commerce. Thirdly, mobilizing domestic savings to be channelized into productive investment. Fourthly, in allowing different risks to be managed more efficiently, encouraging the accumulation of new capital. Fifthly, foster a more efficient allocation of domestic capital. And sixthly, in helping to reduce or mitigate losses. The next function of financial intermediaries is to act as markets for firms' assets. Financial intermediaries have a key role in the restructuring and liquidation of firms in distress. They play an active role in the reallocation of displaced capital. Knowing possible interactions among firms, banks can suggest solutions for the efficient reallocation of assets and of corporate control. Financial intermediaries arise as internal, centralized markets where information on machines and buyers is readily available, allowing displaced capital to migrate towards its more productive uses. Financial intermediaries aggregate the information on firms collected in the credit market and then work as matchmakers between savers and firms in the credit market. Let us understand the link between financial intermediation and monetary policy. Monetary transmission mechanism shows the effects of changes in money supply on aggregate output through the change in spending decisions of firms, households, financial intermediaries, and investors. Monetary policy aims at influencing the stock of money supply and interest rate in the economy. For the monetary policy to be successful, policymakers must have the accurate assessment of saving investment process, capital market functioning, consumer portfolio, etc., for which the role of financial intermediaries is crucial. As financial intermediaries deal in financial claims, they know that a financial claim becomes attractive on account of its desirable features like security, exchangeability, and interest rate. This means that people can adjust portfolio of assets in response to change in the combination of these features. If interest rate rises as a result of monetary contraction, the exchangeability of financial claims will fall. Similarly, a higher interest rate will lead to a fall in the stock of money relative to national income, that is, a rise in the income velocity of circulation. This interdependence of structure of claims, levels of interest rate, and flow of money income leads to a link between financial intermediation on one hand and monetary policy interest rate on the other. Financial intermediaries like commercial banks can create credit and can act to the stock of money and the resulting money supply. Now, we will summarize what we have discussed in this module. Financial intermediaries mediate between entities with surplus funds and those who need these funds. In their role as a link between borrowers and savers, financial intermediaries create liquidity, reduce transaction costs, and minimize the asymmetric information problem prevalent in the financial markets. There are two types of financial intermediaries: bank and non-bank financial intermediaries. While the bank financial intermediaries provide short-term finance, the non-bank financial intermediaries cater to the long-term financial needs. Financial intermediaries promote economic growth, help in reducing poverty, mobilize financial resources, and thereby bring about positive development in an economy. Over time, with financial developments, the role of financial intermediaries has been expanding and changing from the basic function of mobilizing savings and lending to more advanced functions like risk management, portfolio creation, etc. Banking financial intermediaries create money through the process of credit creation, thereby affecting the stock of money and the effectiveness of monetary policy. There is a two-way link between financial intermediaries and the monetary policy of the central bank.